Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. Today is the first of 3 videos that we're going to share with our clients as we talk about our 2023 outlook for investors. Now, Eric, we're going to start off with one of the biggest topics of the year is the tremendous increase in interest rates. And so how do you think that is going to impact fixed income investors going forward? And I guess part 2 of that question is, how does that going to impact cash investing?
Sure. So higher rates means that returns from fixed income and cash going forward are going to be much more additive to total returns within the portfolio. We briefly addressed this on a previous call, Paul and I did. We're currently buying or creating fixed income portfolios that yield 4.5% to 5%. Mid-2021, we were at 2%. And as you can see on the chart, it means 2 notable things. One, we can either get more return, total return going forward without rebalancing the portfolio, or 2, reduce allocation to equities and get a similar return with less volatility in the portfolio. Throughout 2022, we allowed cash to build in portfolios, even taking from fixed income and adding to cash. And we have started to reallocate back into fixed income, and we see ourselves doing that certainly through the early part of 2023. We do believe the Federal Reserve will likely stop raising rates in the first quarter of 2023. And by the end of next year, there's a chance that they start cutting rates, or at least begin the conversation of cutting interest rates.
So Eric, clearly we know that for fixed income investors, it's the best market that we've really had since the early 2000s as far as interest rates. But we also know as investors, higher interest rates also have a negative connotation for the economy and parts of it. So can you share some of the thoughts there?
Absolutely. There is a downside to higher interest rates. And as you can see in this chart, the Federal Reserve raised their target rate at the fastest pace in decades, going from 0 to 4.25% in less than a year. This rippled through all asset prices as stocks and bonds substantially declined, and housing prices have started to decline for a few consecutive months. We expect the downward trend in housing prices to continue. This is an obvious statement. Higher interest rates, though likely are plateauing around where they're currently at, will make it far more challenging for businesses to access capital. It will be much more expensive and ultimately slow their business. Additionally, the ability to raise capital through equity is typically not on the table and certainly not ideal.
So clearly corporations have an impact. You briefly started talking about the housing market. Mortgage rates, that's probably one of the biggest impact to consumers, and we know consumers are a big chunk of the economy. Yep. So let's talk a little bit more directly about how consumers are impacted by the higher interest rates.
It's important that we hit on the individual. Consumption is 2/3 of the US economy, and a home is the largest purchase or investment that the majority of Americans will make in their life. Mortgage rates have more than doubled over the past 18 months, meaning that the payment on a 30-year fixed rate mortgage is 50% higher than where it was in mid-2021. In other words, a $1,000 payment is now $1,500, which translates into about $6,000 in additional mortgage payment over 12 months. This will not only just affect the cash flow for the consumer, but also the ability to buy and sell homes, and additionally one's willingness to access the equity within their home. On the flip side, the majority of Americans previously either purchased a home or refinanced their home while rates were at historically low levels for the past 10 to 12 years. And last but not least, these higher rates are going to benefit savers, going to provide more return to their cash and their fixed income portfolios.
So Eric, obviously an impact to the consumer that's borrowing and a benefit to clearly our savers. In our coming weeks, you're going to see a second video from Rob Romano, our Director of Research, as we share the 2023 outlook for the stock market. As always, thank you for the opportunity to serve you and your family, and to have a great holiday season.